your host, Henri Arslanian, and welcome to the Future of Money podcast. My goal with this podcast is very simple. It's to go deep in some of the biggest ideas, trends, and developments we're seeing in the field of crypto, and hopefully empower you with this information, and then let you make your own decision on what their impact can be on the future of finance and money. To do this, I invite each week one of the leading figures of the global crypto community to have a one-on-one conversation amongst crypto aficionados and discuss some of these topics. My guest today is Michael Ourabah, the CEO of BSO. One thing you may not know about Michael is that, believe it or not, he likes roots reggae and that he was an early gamer. He's been actually playing with computers since the age of 3. So here we go, an early adopter of technology. Michael, great to have you with us today on the Future of Money.
Hi, Henry. Hi, everyone. Thank you very much for having me. I'm really glad that I've been invited to talk to you today.
So Michael, before we talk, there's a lot of, obviously, one of the goals we have today with the session is to talk about high frequency trading in crypto. What is market making? What is the role that HFT, high frequency trading, has in crypto? But before we go into those really technical matters, I think it'll be very interesting for our audience if maybe you can share about yourself, your history, and also about BSO as well, just so that our audience has some context.
Yeah, absolutely. I can certainly do that. So I started BSO, as you rightfully said, back in 2004 when I was in college, and at the time, I felt that even though I learned most of everything when I was growing up on my own about computers, what I was learning at school wasn't really meaningful. I was like, okay, let's start a business. I'll learn how to run a business. And on top of that, I'll try to do something meaningful in the global networking environment worldwide. So we started BSO back in France with Charles, my business partner. And we grew organically. And while spinning off and opening the office in London, we couldn't replicate the exact same business model we had in Paris because the vertical markets were widely different, obviously. In London, the city finance, capital markets. And it was right at the time when electronic trading and algo trading became prominent. And obviously, nothing makes more sense than having the information before other people, because that makes you powerful and gives you the ability to make a decision to trade or not something. And obviously, that's when infrastructure and telecom, specifically here, low latency network telecommunication services, enables seeking more alpha. When the whole chain depends on sourcing the information in Chicago, executing a trade in Tokyo, you need the underlying infrastructure between these 2 points to be able to be faster and trade better than others. And that's what we do at BSO. We operate a global network that covers over 250 data centers and public cloud on-ramp regions of every single cloud provider. And we have built the best of breed, lowest latency network between all these data centers worldwide. Most of them being either where a matching engine of a liquidity venue and exchange is located, or where there is OTC trading happening. So to sum up in one sentence, we basically provide the underlying infrastructure supporting the mission critical applications of our clients. I think that's what sums it up the best.
Well, I think there's a lot of topics here I want to talk about in the role that this kind of infrastructure has in crypto and what it is. Actually, in particular for crypto clients, maybe what is the services you guys are offering for some of these crypto funds, for example?
That was really the combination of two products that we had. We had obviously the traditional low latency network between data centers, and we had developed a cloud and cloud to cloud, DC to cloud and cloud to cloud product, which enabled customers to transfer their private data between their public cloud instances with different cloud provider agnostically. So you could have something in Amazon AWS Dublin and AliCloud Hong Kong. There's absolutely nothing that exists in the world right now to connect the two, where basically we have developed this web portal where customers can log in, input their ID of their two instances, respectively in Amazon and AliCloud, gather the private keys to authenticate the connection and enable it. They do the same in the back office of Amazon and AliCloud. They click provision, and automatically our network is going to connect the two instances for them seamlessly with nothing to do. Well, basically we've done that whilst encompassing predictive, stable, and lowest latency between the two cloud on-ramps that we have, giving the opportunity for, in its infancy still, but we'll probably talk about it, these crypto algo traders, arbitrage firms, and to have a lower latency between the the vast ecosystem of the numerous public centralized crypto exchanges.
Absolutely. Well, I think there's a lot of things. I think, Michael, let's go one by one. I think maybe for the benefit of our audience, right? Can you first, before we go into details, explain what is high frequency trading in crypto and why is low latency so important when it comes to high frequency trading in crypto?
High frequency trading is basically the ability to execute tremendous amount of small little trades after having taken the right decision with gathering source of information for everywhere in the world. You basically derive a decision based upon a piece of information coming on Bloomberg, analysis on Twitter on a specific keyword, gathering the market data of the VIX in Chicago, which you probably know what it is, but it's basically an index about volatility on the markets. And then you can elect a decision and pass thousands of trades here, creating a small movement, and then it's going to create some general movements of the market. And then you can decide to sell because of these micro movements, creating an alpha with a few thousands of a cent. But if you do that 10,000 times a second, then obviously at the end of the day, on so many markets, so many opportunities, then you create millions of dollars. But the recipe for winning is one, being able to consume all this data, analyze all this data, and two, doing this faster than everybody else. So to do that, you need to source the data with telecom services fast, compute the data with dedicated FPGA hardware to basically strip off any processing time that a normal computer would have, which is extremely slow. Well, in our world, obviously. And then execute the order same way, extremely fast. And obviously, there is over 20 years of technology and R&D in the capital markets that supports this whole environment. In crypto, there's 13 years of development on the software side of things, removing infrastructure into the public cloud so it's not a headache. And then now that it's getting more professional, it needs to keep up.
As you said, there's obviously sourcing of data, the processing of it, and obviously then the execution of the trades as well, which is obviously key. And I think the interesting thing, a lot of the crypto markets are able to benefit, I guess, from the decades of expertise now in traditional markets. And what would you say from your perspective, Michael, is the benefit of high frequency trading for the future of crypto markets? Is it beneficial? Does it make the market healthier? Or you think there's also drawbacks as well with the rise of high frequency trading in crypto?
So let's take a quick step back first, because the question you asked is really interesting. It's a question that's been asked for the last 20 years by the regulators, by like the SEC, the CFTC, or any financial regulators in the world, just about traditional assets. Okay, whether it's a stock, a bond, FX, options, futures, whatever it is. There's always been this question: is this healthy to have these crazy high frequency or algo traders doing 95% of all the trades globally? But are they just wash trades? What are they bringing to the table? What's the value add? What's the benefit? And I think that question is completely valid as well in the crypto world. And the outcome of all in the capital market is that, yes, they're extremely valuable because, number one, they're giving so much liquidity to the market that anybody who wants to sell or get rid of an asset or buy an asset will find it, just because somebody is making profit by, one, market making, but two, using the arbitrage, and three, just buying and selling and making just a tiny bitty amount of profit. It's his benefit. Then your benefit is just to get rid of your asset very quickly. So there is a value to that. In crypto, it's a bit different because it's already, automated market makers, algorithms already exist inside decentralized exchange. It's inherent to the mechanics of a DEX. Market makers, centralized exchange have their own market maker bots usually existing inside them. But we all know that these market makers are everything but what a real professional global market maker that has complete view of everything does. It's a no-brainer on that. So the biggest thing is educating people in crypto that, yes, they have the same tools almost like capital markets, but it's nowhere near as professional and efficient as it is in the capital market. So there is a huge room to grow. and get to the right level to get where we need to be for crypto. Crypto has a 24/7 trading environment, 365, which in itself gives a lot of ability to manipulate the markets. And we all know that very few amounts of people can manipulate and influence the price of all these digital assets. So bringing big, large hedge firms, HFT trading firms into these markets is absolutely gorgeous for stabilization of the price, for liquidity, for ensuring that trades are valid, for reducing the impact of the tempering of the markets by these big whales deciding to suddenly borrow 150 million USDT on Aave and start to liquid short all futures at the same time on every centralized exchange. And then at the end of the day, close their futures position, times 10 what they've invested, i.e. $1 billion, and then buy back Bitcoin very cheap. I mean, let's face it. We all know that. That's what's happening. And it's start and repeat. Shake people's, buy the Bitcoin cheap, and then go back again. I mean, these type of mechanics would not happen if we had all these big HFTs coming in with trillions and trillions of volumes, just because it's going to cancel it, you know?
I think you raised so many good points. I want to go more in depth as well, from market making to automatic market making, the whole AMM as well, and the impact. But before that, maybe for the benefit of our audience as well, can you maybe explain, briefly what is market making, and actually what is the role that is at play in crypto markets on a pure market making perspective? And then we'll talk about automatic market makers.
It's quite easy. You have an asset that's trading on multiple marketplaces at the same time, whether decentralized or centralized. If you have large amount of liquidity and volume hitting one specific single matching engine or exchange, you're going to see a price event and the demand and the liquidity on this exchange lower. So the price impact is going to be big. So let's assume somebody comes in and buys $100 million of Bitcoin on a smaller exchange somewhere. The price might go up 15% or 5%. But the price is still the same everywhere else. So there's the ability to arbitrage the markets, i.e., for the sake of clarity, if Bitcoin is $60,000 everywhere, and on this small exchange somebody buys a lot, it becomes 60,500, then you can immediately make the decision to go buy on Binance $100 million of Bitcoin at 60,000 and sell it at 60,500. It's as easy as that. And the spread between these two pricing, this is the arbitrage opportunity. A market maker is going to look at every single market at the same time, all the pricing, and make the decision to buy and sell to basically make the pricing converge so that the order book is matched absolutely every place at the same time, at the same moment. That's the role of a market maker.
Absolutely. I think, and as you mentioned, it plays a very healthy role as well when it comes to price discovery and making sure actually we have efficient markets as well, in addition to providing liquidity you mentioned. And before we talk about, obviously we want to focus on a lot of the infrastructure about crypto as well, especially in a HFT perspective. But before we go into that, you mentioned before the whole rise of DeFi, decentralized exchanges. In traditional markets, of course, we're used to an order book. We know where it's everything is there. We have a centralized order book, and of course now with DeFi exchanges, the concept is actually completely changed. And obviously we have these automatic market makers. So what is your view? What is your view on, you think, the potential for high frequency trading with these AMMs, but also what do you think is the impact it can have on the growth of the HFT industry in crypto?
So decentralized exchange, as you said, works wildly differently. You have what's called the liquidity pool. So the owner of a token or somebody, whomever it wants, by the way, might decide to create a new trading pair on a decentralized exchange. The way it works, that exchange is going to request that you put in their custody, wrap into their smart contract, a trading pair. So one token and another token. But to do that, you need to fund these two liquidity pool evenly. Price will be set at this start of the trade. From here on, the automatic market making is going to adjust automatically the balance of the pool of token number one versus the balance of pool number two. And the imbalancing is going to create automatically the difference and change of the pricing of that token, which is not the reference token. Usually you have a reference token, which is either wrapped ETH when it's on the Ethereum blockchain, or the other native token of a layer one token that operates on, or a stablecoin like USDT, USDC, DAI, or anything like that. And this concept of automatic market making has the benefit of getting projects off the ground with no listing fees, with decentralization at its best. The beauty of the code that does everything and makes everything possible. That's basically what it is. But it has a few drawbacks, obviously. The main one being that if you start a liquidity pool with not sufficient amount of tokens, price impact at every single trade is tremendous. And the only way to counterbalance that is either to create much bigger liquidity pools to ensure that price impact is not as big, but the person putting their tokens into the liquidity pools are going to get burnt because they're going to lose money there. Or the other option is to also have volume and listing on centralized exchange, because this creates a massive amount of slowdown on the pace a decentralized exchange is going to get drenched or drained when people come and buy tokens. And then that's the role of the market maker. Trade on the centralized exchange, and whenever it needs to sell tokens over there, source the tokens from the liquidity pools of the decentralized exchange, and making sure that there is a balance between these all. That's what the market maker does.
And would you agree that actually it's very difficult for decentralized exchange to grow without the centralized exchanges? I mean, at the end, its core, they kind of work as the left hand and right hand has to work together for both to flourish to a certain extent?
Well, let's be clear. Decentralized exchange is the very thin amount of volume on trading these days. It's super small. Why? Because number one, it's extremely complicated to understand. Only the educated people who've taken on themselves to read a lot about it, understand so many financial and DeFi concepts. And number three, have practiced them for a while and agreed to consider that they're going to lose a few thousands of dollars just for the sake of understanding how it works and grasping with all the concepts at once. So the barrier to entry because of these difficulties is already huge. So centralized exchange is a gateway to crypto and blockchain trading for the masses, and decentralized exchange is going to be the gateway to the masses of projects to get off the ground. And as you rightfully said, for me, DEXs bring projects and tokens out of the shade without the need of lots of marketing and money and VC funding. And centralized exchange bring non-knowledgeable people into crypto through their gateways. And as you said, it's a whole ecosystem that needs to work together hand in hand and cannot coexist without each other.
And I mean, there's obviously other risks as well. We don't have time in this podcast to talk about it, from impermanent loss to others that obviously make some of these DeFi liquidity pools a bit more challenging. I want to talk about the crypto infrastructure. Of course, if you want to have a healthy, high-frequency trading ecosystem, the infrastructure needs to be there, right? Where do you think we are in the evolution of crypto high-frequency trading infrastructure on a scale to 1 to 10, especially compared to traditional financial markets?
You're probably going to laugh, but I'm going to be extremely critical of that. I think we're probably at 1 out of 10. And every time I speak with people, they have the same reaction as you do, which is, what are you talking about? Well, like using all the Web 2.0 technologies, we're completely agnostic on the infrastructure side. Everything is in the public cloud. It's gorgeous. It's exactly what should be. And I'm like, yeah, that's what should be when you're a coder, when you're a tech guru that's just coding and behind your screen developing applications and making it available to the public, and not caring about what's happening in the background. But the reality is, it's widely inefficient. Running off of the public cloud is widely inefficient if your intention is to have state-of-the-art, fair and equal access to price discovery for everybody with established and infrastructure that's not going to be subject to throttling or clogging up. And let's be clear, who has not seen the behavior of the crypto exchanges in highly volatile moments? Let's look at September again, when there was that big Bitcoin crash, when they short squeezed all the futures that were long. You could see swinging on the crypto exchanges, pricing of Bitcoin from 50,000, 43,000, 54,000, 44,000, like in a heartbeat. When you see that, it's clear. The matching engine cannot cope with the volume. It's completely lost. It needs to balance and even itself out. All these exchanges are desynchronized with each other. That's exactly what it is. That's completely wrong about crypto, because during these highly volatile time, you have people that get liquidated for no reason because they just cannot even go clear their position or add collateral or anything. That's just the basic of it. And when you think about it, that works when it's you and I who is an early crypto adopter and has whatever millions in crypto and decides to gamble on futures on centralized exchange. But the minute you have institutional money coming in, who's playing with 5, 10, $25 billion under management and decide to actively market make or trade, or I'll go trade this. What do you think is going to happen if they lose $150 million or $300 million because the matching engine was lagging? Well, we're going to have a big lawsuit. And yeah, I mean, there's a lot of things that needs to be done to improve that.
But what do you think so? I mean, Michael, on this, because I totally agree. I think there's from the exchange, the matching engine and the infrastructure there needs to be up to par. Because even if we have a lot of quant funds or high frequency trading funds, if the engine is not able to cope with it, then there's no point, right? This is having a team of football players, but the court is not ready for them to play football, right? So it doesn't work on that perspective. I mean, what do you think is the reason? Because a lot of people that went to build these crypto exchanges come from the traditional financial industry. Or you think it was really built with a tech Silicon Valley mindset first and not a financial service mind? Why do you think a lot of these crypto exchanges don't have the infrastructure to cope with this high volumes and volatility?
It's few key insightful execs from the capital markets who usually were not really into the infrastructure supporting the trading environment. Because you can take a tier one bank. They have prop trading desks and prop trading thing and execution and order entry for their prime brokerage business. Whatever, you mentioned it. You're going to have 40,000 people worldwide leveraging this trading infrastructure. But the core team supporting this infrastructure for execution, order entry, and whatnot, it's 20 people that's scarced and scattered between Hong Kong, New York, and London. So, of course, somebody insightful from either an HFT or a bank that's leaving the capital markets industry to spin off an exchange or quant fund, he's going to have the basic concepts of trading and arbitrage and low latency and all that. He understands that, but he doesn't understand what it takes to do that. And he's just going to surround himself with the brightest and most talented dev that he can find, which are coming from the Silicon Valley. And their world is infrastructure is not relevant. We're just here to create the best of breed software with the best feature, and the rollout needs to be instant, immediate. And for that, we're going to use the beauty of public cloud hosting. Infrastructure is removed. We have this layer of abstraction where we can just click on a button, link it with our GitHub, and then the rollout and provisioning of pre-production, production, test environment, and production is seamless and all scripted and immediate. It's so fast for me. I don't have to have a team of infrastructure engineers that are going to roll out the infrastructure for each of my environment and move the versioning of my software through it. They basically remove the clogging up of the process from their world. And that works very well to kickstart a project. But then that shouldn't be the case for the full breed production environment. And this is where I believe there will be, and again, that's me after speaking with so many exec and CEOs of centralized exchange, trying to explain them that if they want more volume, if they want professionalization of the environment, if they want institutional money to come in extremely widely, they will have to think about breaking up the infrastructure in two things. Number one, continue with the public cloud provider for the masses, for you and I, for private individuals that want to trade and be involved on these exchanges. And then they're going to have these public exchange matching engines connected to dedicated access points of the matching engine running sideways in key physical data centers where all of the capital market and institutional money is located. And for various reasons. Number one, do you really think that the regulator is going to allow JP Morgan or Citibank or the big brokers to execute all these trades over public crypto exchange and public cloud? If there is a denial of service on the internet, they cannot clear their position. If there is this and that, they can't clear their position. Then they're in breach of their own regulatory obligations with the regulator. I mean, let's be clear. I have these tier one banks coming to me and saying, oh my God, we have to do that because we have this spin-off in the group that's trading digital assets, but I need to connect to these 4 key tier one centralized exchange, but I'm afraid we can't do it over a VPN over internet. This is too risky for us. What can you do? And then we create this whole infrastructure where we connect them from the regular data centers in New Jersey where traditional exchanges are located to these crypto exchanges through multiple physical paths in the world, and on-ramp that are diverse with each other. But that's, it's a stopgap solution. It's not a long-term solution. And again, they're going to want something that's going to be fair for them. When you're going to have like 40, 50 players that are plunging 10, $50 billion every day of trades on an exchange. They're going to want and be guaranteed that, one, when they send an order, they want to make sure that the distance of the cable from the matching engine to their infrastructure is exactly the same as their competitors. They're going to be like, why the hell does he benefit because he was connected 6 months before me? It's unfair. And this concept of fair and equal is going to evidently come to the table very soon. And to do that, you need the level of infrastructure, which is widely not what public cloud provider can guarantee these days.
Unfortunately, we're running out of time, but I think from, two questions. One of them, I guess, the whole concept that we have in traditional finance with colocation, for example, you think this is something we're going to see? And I would even argue, I think, do you believe actually the next big exchange right now with the Binances, the FTX we have of this world, technically it's a complete new whiteboard design that needs to be made if we want to have these significant amounts of capital. Do you agree that there's still a lot of opportunities for somebody or even the existing players to build this new kind of exchange that has the capabilities to trade with the low latency requirements that institutional investors have?
Oh, I'm a firm believer it will happen slowly and slowly. And the reason is the market is always getting itself improved for the sake of alpha discovery. Tomorrow, one guy decides to strike a deal with Amazon and say, hey, I need you to put inside the public cloud, inside your cloud instance, this dedicated hardware that I've built, which is an FPGA doing execution on the exchanges because I need that for my trading. Tell me how much it's going to cost. Maybe one guy's going to get allowed to do it, and then it's going to open it in the Pandora's box. If it's not allowed, then this guy is going to build a solution where he's going to convince a crypto exchange to become professional and open an instance in a physical data center. And then that guy's going to put that FPGA here. And then you're going to have 40 guys that are like, what the heck's happening? My goals are not working anymore. Instead of 40% return per day, I'm down to 3%. And then he's going to start to explore. And he's going to be like, what? Somebody's got an FPGA for crypto trading. Man, I need to do it as well. He's going to have a team of 40 engineers. They're going to do the R&D for 6 months, then get it provisioned, designed, put it in place. And then 2, 3, 4, 5, 10 people are going to have that.
And one last question, again, quickly, Michael, in like 30 seconds. I mean, of course, there's, from your perspective, you guys deal with a lot of the traditional high-frequency trading firms, the ones in Chicago and other financial centers in the world. Are you seeing those firms more actively now entering the crypto space? If yes, why? And if not, what is slowing down?
I'm going to answer that all of them are already in crypto for years, but small amount of their trading desks. What's happening now is that all of their trading desks are starting to realize that there is correlation somehow, that there is money to be made with their existing algorithms and trading assets and assets that they're trading. So they're completely getting into it. So we're going to see an even bigger influx of their capital into the crypto markets, but they're all already there, or most all of them.
I think for anybody who's involved in high frequency trading who likes arbitrage opportunities, I mean, this is it's a dream come true in a certain way from that perspective. Well, Michael, that's all the time we have today, but now it's time to finish it off always with a bell. The bell is back with me. For those of you watching this on YouTube, I'm still in quarantine in Hong Kong in the hotel room, but I travel with the gear now, so it's good. So, Michael, what I'm going to do now, I'm going to ask quick questions to you. I need 1 or 2 word answers, and we're going to wrap it up like that. Are you ready?
Sounds good. I'm ready.
Excellent. Let's kick it off. Michael, when you're not busy with running BSO, what is your favorite thing to do on a weekend?
Scuba diving.
Scuba diving, really? Wow. I'm an advanced diver myself. I do a lot of night drift.
Well,
and everything. It's a whole different podcast as well.
Exactly.
Let's continue. You're French. What is the favorite thing you love to do when you're back in
Eating.
France? Not surprised. And another question is obviously a lot of French in high frequency trading and algo trading and the derivatives world. Why do you think you have so many French people in these spaces in finance?
Education.
Yeah, I was not surprised to hear that. Okay, what is you started BSO as a student out of university? What is your is this something you would recommend other students to do to launch their business out of university, or they're better off joining a big company first?
Yes, start your business. There's nothing better and more rewarding than being an entrepreneur.
So what industry would you be in if you were not right now in finance or in crypto? What industry would you be involved in?
Healthcare.
Oh, really? Why is that?
Well, that's not going to be a one word answer, but I'm still going to answer quickly because I firmly believe that decentralization and DeFi is the way that's going to bring fair and equal access to wealth and sharing the wealth amongst everybody worldwide. And at the end of the day, I've been pretty much a bit appalled and despite being in that whole environment by the fact that it hasn't been redistributed properly through the normal way of capital markets. And I think that DeFi, blockchain, and digital assets is going to enable that tremendously. So I'm really happy that it's going to happen, because at heart, I like people to basically enjoy and be able to enjoy life as much as I do. So I would have done healthcare to help people.
That's amazing. Love it. The last two questions. What is the one course you recommend every student at university takes? One course they should take?
Accounting.
Wow, really interesting. Why is that?
Because it's actually, unfortunately, so important in whatever you want to do. If you don't understand accounting, you cannot create a business plan. You cannot raise money. You cannot start a business. You cannot understand how a business runs. Of course, you can just forget it and hire people to do that, but it's going to be slowing your growth and not understanding how things work and how the system works. And unfortunately, we're still in the system.
Absolutely. Well, double entry counting was created in Italy 100 years ago, and unfortunately will still be here. And the last question today, Michael, that you with us today for the last question, Michael, if you can have lunch with one person, dead or alive, one person you can have lunch with, who would that person be?
Probably Albert Einstein.
And why is that?
Because this guy's a genius. He set the whole world of physics and how we envision the world for years. And it still hasn't changed until now. Maybe quantitative physics is going to demonstrate us something different, but I would love to take his stance on this specific topic, by the way.
This is an excellent question. We cannot even stop with towards these things. They're so interesting. That was Michael Ourabah, the CEO of BSO. Michael, where is the one place people can find you if they want to keep in touch with you?
Twitter is fine. LinkedIn is fine. I'm available. Telegram. I'm everywhere.
Excellent. Well, thank you very much, Michael. Thanks for being with us again. Thank you for all you listeners at home. Make sure to click subscribe and give us a 5-star rating if you like this podcast. It really, really helps with more people discovering the show. A new episode will be released every other week. Again, if you want to stay on top of the latest developments on crypto and on the future of money, make sure to follow me on LinkedIn and on Twitter, especially for my weekly Crypto Capsule show, where I summarize the global crypto developments you need to know in less than 60 seconds. And of course, if you like newsletters, don't forget to subscribe on LinkedIn or review to my weekly newsletter called The Future of Money, where I share the 3 big ideas on the future of money that you need to know each week. And of course, education is very, very important. So if you want to learn more about crypto, make sure to also check out my YouTube channels, where I have not only videos of previous interviews, and the one with Michael will be there as well, but also a lot of other educational, crypto-related educational content. And the good news now is all my video content now is also available, not only in English, but also in French, Spanish, Arabic, and Mandarin, Chinese in my respective channels. So thank you again for your time today, for joining me today on this episode of the Future of Money podcast. Thank you very much, Michael, and see you all next time.